Good evening, everyone. I'm A.F. Thornton, and I'm the Chief Investment Officer of Blueprint Quantitative Strategies, also the designer of the Navigator algorithms. I guess that's one of the most famous things on my resume, right? Pretty funny. Looks like we're getting an echo. Got to get rid of that, or that'll provide something interesting on the broadcast here. All right, so it's Sunday night. Friday was the last trading day of the month. So let's, from an outline perspective, let's go ahead and talk about the competing narratives out there briefly. And then we'll look back on the month of July and see if that will tell us anything about the future. We'll also look back on last week, see what that has in store for us, and then we'll build our sandbox for the week. But let me kind of bottom line everything for you. If we look on the monthly chart, we have an inside bar for July. So I guess the good news is it didn't go to a new low and we finished at the top of the bar. So that's at least slightly bullish. But as always is the case on the monthly chart, we've reconnected with the 5 EMA, which is sitting around 41.25. So the key to any monthly chart is whether we close the month above or below that level. Now we can spend a little bit of time above it, and that doesn't necessarily tell us that we're going anywhere, but the 5 EMA is the key, and we're going to find out shortly if we can break up above the July and maybe even the June highs. That's really the key to everything right now. Looking back on last week, the 89 or even the 89 EMA or the 100 SMA is really the key there. It's up around 40.83. We need to, for the bears, they've got to keep it under that level. Again, we can close up there for a few weeks, it's not as long as it's not significantly above. But that's the key to the bull bear case as far as the weekly chart goes. And then as far as the daily chart goes, we'll talk about in the competing narratives that this is sort of a FOMO rally. This is a money management business rally. Doesn't have a whole lot to do with fundamentals. The structure over the last few days has been weak, so I'm looking for a liquidation break pretty soon. But the question is, can we take it up a little bit higher and test the June, July highs first? Because there's just a lot of cash on the sidelines trying to get position. It's very, very hard to get much of a dip, at least over the last week or so. I call it it's kind of a late bloomer since the 40-week cycle actually bottomed, some time ago. So at any rate, that's the outline. So let's hop right to it and let's talk about the narratives. So you've got two narratives going. The first one is that this is another bear market rally. There's plenty more bad news to come. The world's still coming to an end. And the only question is where and when the sellers are going to pounce on this. So that's the first important narrative. I guess my only problem with that narrative is that there's way too much consensus, at least in my world, that that's the case. So part of what goes through my mind is, will this market go a little higher or even higher than people expect? It really draw a lot of people in. Those of you know who followed us, I looked at this whole wave down into June 16th, 17th as a leading diagonal. And if that's the first wave of a bear, we can retrace a lot of that downdraft and still be in a bear market. We'll talk about the 50% retracement because that's in our windshield this week, but in any event, keep that in mind. Now, the alternative narrative, I guess what the bulls are betting on is, a Fed pivot. And I think there's some recency bias built into that. They're so used to the Fed bailing everybody out. We've got the ECB tightened interest rates, kind of reminiscent of 2008 when they tightened right into Armageddon. And we have the Fed tightening into a recession. We do have a recession no matter how many ways the Biden, or I call him the Orwell administration, would like to redefine it. So it's unusual for the Fed to tighten into a recession. Certainly in my career, I don't remember that happening. I'm sure it's happened, but that's something that is pretty rare. So the bulls think that the Fed will have no choice but to pivot, maybe even, by September, because, you got elections coming up. They are somewhat political, and I suppose the other thing the bulls would argue is that, money managers, hedge funds have some of the highest cash positions they've had since the bear market of 2009. And the negative sentiment has barely moved the needle here. So, there's certainly plenty of cash to drive the market higher. And my position on all this is, I let the price take me where it wants to go. I don't know if it's even any point in forecasting things, but this is a FOMO rally. This is when you're in the money management business and you're managing other people's money. Even if the market goes down 20 or 30%, as long as you are losing less than your peers, a lot of clients will stick with you. But there's no sin worse than sitting on cash when the market takes off and rallies, and that causes money managers to lose business, lose their fickle clients, hedge funds as well. And believe me, there aren't a lot of money managers or hedge funds that have done well this year. And so they'll tend to basically chase the market because they're afraid of losing their clients. So definitely keep that in mind. I don't know where we're getting some feedback here. Hold on just a second. See if I can figure out where that's coming from, because that's going to double loop on us. I think it's coming from my phone, of all places. Well, we'll see if I have time to edit that out. But in any event, those are the things we have to worry about. So let me just briefly jump into some precatory language here that we have to provide you. You already know this because you're smart enough not to take your advice from the internet, but we're not financial advisors. And, these videos are to help you learn. They're educational. They're not meant to be investment advice. And you'd be crazy to just jump off one of these sessions and go buy or sell something. So I think it's just kind of common sense, but we got to tell you anyway. Here's my translation. You can always take a peek at this on your, just take a picture of it or something, whatever helps you. And then, even though we've had this channel for 2 or 3 years and had a couple of things up, we've never really used it until the last few weeks. So we're just starting. This is certainly all new to me. So we'd appreciate any help you could give us in supporting the channel as we continue to grow here and build a community. And basically give us a like if you like the information. Consider joining the channel, and also hit the notification button if you want to know about these future videos that come out. Try to do these every day, every morning, just briefly, just kind of going over our sandbox and our plan. So, and then you can go over to blueprinttrading.com or blueprintquantitative.com. Always remember to leave the E out of Blueprint. So you can go over there anytime, and there's a lot of good information there, and particularly in the blog. And we also do a trading room on Tuesday and Thursday mornings, and we only started that a few weeks ago, and we've not had a bad session yet. We've been doing really, really well. So at any rate, give that some consideration, and now let's just jump into it. So I want to start with the monthly chart here, and what you see is the monthly volume profile, which includes all volume at the prices that we're trading in at the current time. And if you don't understand volume profile, let me just simplify it for you. These high volume nodes at these prices are where the market will encounter resistance. So whether you're going north or south, when you encounter these high volume nodes, the market's typically going to stall, and sometimes it reverses. You also will see the market stall at these low volume nodes. And in fact, if you take this low volume node to this low volume node, you can kind of consider this an auction. And it behaves like an auction, all of these different peaks. So the theme we've been on the last few weeks, really since the beginning of July, was that we had this air pocket in here. And we have some down here as well, but I said if we were able to get over this high volume node here and into this air pocket, that the market would move pretty quickly. And I think it has. It certainly did its biggest move this past week, but we've been moving through this since June 17th, so that was a major thing to conquer. And of course, our next high volume node is sitting here at 4180, which will become relevant. Let me introduce you to the sandbox concept. We go into the option market, and we look at the weekly options that expire at Friday's close. And it's best to do this on a Friday or use a Wayback Machine to do it on Friday. And what we see is basically where the market can travel during the week. And in this week, the low side is 40.50, the high side is 42.15. So it's plus or minus 81 points, almost a 160 point range. Now that we're in positive gamma, the volatility is contracting a little bit. So we're not seeing, like the 200 point range we did a week ago. But there's a 70% probability that the market will close inside of this range for the week. So as we approach the top or the bottom of the range, that might influence whether we're going to go long or short. I've marked some of the other high and low volume nodes here in red and green, but these are areas I'm going to watch throughout the week because they will provide support and resistance. Now, last week we did close outside of the weekly expected move. We closed above it. We got into a gamma squeeze Friday afternoon. So that's another thing to keep in mind. There's a concept I always emphasize with people. When what should happen doesn't. Some of the best signals you're ever going to get in the market is when you're expecting to something happen and it doesn't. When the market, especially late in the week, during the middle of the week, the market can exceed these ranges. But by the end of the week, it needs to close inside these ranges or dealers and market makers lose billions of dollars because this is all priced a week ahead. So they will defend these levels, which is why, 70% of the time you stay within them. But if you do break outside of them, especially late on a Friday, what happens is you get what's called a gamma squeeze, or just a squeeze in general, where in order to hedge their option risk, the dealers have to, basically go in the direction that the market is. So if you get above here, they have to buy futures, which is going to fuel the rally even worse. I mean, it's the worst thing in the world if you're a dealer. And if you get below here, they have to sell futures in order to hedge. So when you break outside of these ranges, as we did Friday, that can be pretty nasty. This is calculated based on a 1 standard deviation move from the implied volatility. So we have had, over the last few months, 3 or 4 weeks where we did break outside the range. So another concept that I try to get across to everyone is when we look at these levels and things, always remember these are things that you want to have an awareness of them, but not be married to them. And that is a hard skill to hone in trading. Because, if you get up here and you don't get a pivot or the other things that are associated with a turn, you just keep going with it. Set your stops and go accordingly. So this is from a monthly, this is really big picture perspective on where all these high and low volume nodes are. And then we can kind of drill down to a weekly chart and get it a little bit granular. And, I have all these levels marked here, and then you come down to the daily chart and you get it even more granular. And what you can see on the daily chart is once we got through this air pocket, it's kind of crowded up here. I mean, there's not a lot of, the whole area is prominent with a lot of volume. That's why if we were able to move beyond this area up above 42.25, which is outside of our range for the week, we would, hit another air pocket and be able to go a little further. So this is going to be some big resistance to get through. And really to make this useful now, we almost have to get down to an hourly chart or even a 5-minute chart to get really, really granular on the volume nodes. But I like to at least start with the big picture here because it helps. And then you can see the sandbox here. And again, 40.50 to about 42.15 for the week. And then this is tomorrow's sandbox. So I also plot these every day. Now that the SPX futures, the SPX options, are available every day of the week, we can use those figures to calculate this. And so this, again, 70% probability that tomorrow we stay between 40.98 and 41.70. So that's another helpful thing. Now, why do I put up these windshields, even if they're just some guides for us? First of all, it helps me decide, when and whether to be long or short. Obviously, the trend is the first influence, but, I'm going to be reticent to short at the bottom of the weekly expected move. I'm more likely to do that here. And in fact, what I do is I establish quarter increment zones for myself to keep my skills honed when I'm, getting ready to short or go long. So I prefer to go long down in the bottom of the range, short up in the top of the range if it's otherwise appropriate. And then the other thing that's important about this, and you'll see this in a minute, is I don't care what's up here and I don't care what's down here. What I want to know is what's coming into my windshield this week, because that's where I'm going to focus, on support and resistance. If the 200-day moving average is down here or somewhere up here, why do I care? Because I'm not going to encounter it this week. So at any rate, but these are how I set up these figures. And then what I do, and everybody, certainly different, is I'll enter those figures using the API over on Bookmap so that, I've got these levels marked as, I'm monitoring the auction throughout the day. And what I look for are stops at these levels and some others. And the reason is that institutions don't use stops, amateurs do. And we compete against the amateurs, not the institutions. We just have to be better than them. So what I like to do is get positioned and then run into the stops. And when they're getting stopped out, that's when I like to get out of my position. And it's an incredible strategy. It works very, very well. So let's jump into then the monthly chart here. And I want to focus on a couple of quick things. First of all, just from a standpoint of location, let's just look at the channels again, just kind of back to the thesis that I've had, which is at the blog on the website at blueprinttrading.com. Again, don't put the E in blueprint. And that is that this is a secular bear market until proven otherwise. And what secular markets, bear markets do is they tend to go to it's a regression to the mean. And this is only the third time we've had a 3 sigma bear market or bull market off the mean, obviously driven by the Fed. The first one was 1929, and we know what happened after that. The second one was 2000, and we know what happened after that, and this is the third one. So in magenta here, you see the 100-year channel. It's from top to bottom, it's roughly 96%, about 48% half channel. So that is your 100-year channel that connects the peaks from 2022, 2000, and 1929. And I could take it back further, but I think that's enough for now. So I'm, operating on the thesis that we're going to head down to the middle of that channel eventually before we finish this bear. And, it's a rising channel, and you have to account for about a 4% slope and rise, as well as, some of the inflation we're experiencing. If we were to go to that channel right now, we'd probably be around 2,600. But over time, the way I'm looking at it, it's probably closer to 3,000. But some of the keys to look at is, this is the last leg of a bull market, if this is the fifth wave, and they will often retrace a bear market will often retrace that entire wave. which brings us down to these levels here, which is the COVID low and the COVID rally low. The other level I focus on is the February 2020 high here, which, and I can actually get back and show you the volume nodes there, but, somewhere in this range here, there's a lot of things that point to this mid-channel area. And in fact, your highest volume node in this market is right in the middle of that expanding triangle. So I don't want to get into that tonight, but that's something that I cover periodically in the trading room. So bottom line is, here's your 100-year channel. Now, in blue here is the 2009 bull market channel, which, started back in March of 09. And I think the thing I would focus on here that's mind-boggling, I mean, we did break outside that channel before we hit the top of the 100-year, but and we're now, up around the 5 EMA, which is a critical level on the monthly chart, and the 21, which is the monthly mean of this bull channel. But this correction that we're in only took us to the middle of the 2009 bull market channel. That's nothing. That's absolutely nothing in terms of a bear market. Now, it's possible that this is just a big correction and things will just move out. I mean, nobody knows the answer to that. It doesn't seem logical or plausible, but it never would at the bottom of a bear market when things are, the sentiment's very low. The average length of a bear market, especially one associated with a recession, is about 16 months. And the average decline is somewhere around 45%. And that, the actual bull market channel from 2009 is about a 40% channel. So each half the channel is 20%. So, when we were in the middle of this channel, I think we were down 23% from peak to trough here. But the only bear markets that, last 6 months like this one, and that, only drop about 20 to 25% are cyclical bears that typically are not associated with recessions. So, look, anything's possible, and I don't even know if it makes sense to look at valuations anymore. The stock market's become a tool of Fed policy. And, I'm not a big crypto fan, and I'm not a big Bitcoin fan for the reasons that you're seeing right now. But I start wondering, is the S&P 500, is anything any better? I mean, this is all becoming pure speculation and a tool of Fed policy. So, forgive me for not, doing the traditional things that we used to do. I mean, you want to look at valuation. I mean, it's getting better, but this is no smoking deal. And, I'm expecting us to go to the middle of the channel as a secular bear market, but, a lot of times it overshoots. I mean, if you were in 1929, it went from the top to the bottom in a very short period. And you can see even the 2007 to 2009 bear market was pretty nasty. I mean, that covered a lot of ground. That's another 50% correction. But in any event, this is my best working thesis, always willing to change my mind, always willing to take in the new data and the new evidence and go with it. Now, the other thing I think, again, just in terms of our location, we are in the middle of the 54-month cycle, which bottomed with COVID. We're in the middle of the 18th month cycle, which is the second cycle in there. But the point of this is that we just bottomed a 9-month wave, which is a 40-week cycle. And we're now basically on the south side of all of those cycles. So you've got the 54-month coming down. You've got the 18-month coming down. That bottoms in March. And the only cycle that's operating in our favor is the 40-week. And we're entering the 8th week of that cycle. So this, if we're still in a bear market, these cycles tend to peak to the left rather than to the right. So very soon, we're going to have all of these cycles coming down. And I also believe that we're in the negative aspect of the 80-year multi-generational cycle that's associated with the fourth turning. So, just have an awareness of this. Who knows? I mean, these are things that I keep in the back of my mind to give the market some structure. The market will do whatever it wants to do, obviously, but these are the things that I'm keeping on my radar for now. So let's move into, a couple of other observations on the monthly chart. Let's take some of this stuff off here. And what I've been advising people is, certainly not on this channel, but people who I work with, if you use the June candle as sort of a breakout range, I think that's, maybe a good way to deal with the market here. The June peak was up at 41.89. The June low is at 36.39. Whichever way the market breaks will tell us a lot. And remember that the market, we always think in terms of up or down. The market could come up here and go sideways. I mean, there's a lot of different ways the market could resolve this overvaluation that we're in. So, keep that in mind. Try not to get married to anything. But I think if we were to move decisively above the June high, that would certainly be a positive. And it's hard to see on this chart. I have to kind of magnify it here, but the June candle again came inside the July candle. So, but again, did finish at the top of the candle. I mean, a lot of positives. The volume isn't all that great, but it also is summer. So, and again, operating thesis here has been that when we hit early July, and actually we hit that June 16th low, we felt it was a 40-week cycle low, and so we've been working these rallies. And we also, looked at the seasonality. Usually the first 10 days of July are the most positive of the year, consistently over the years. And the other thing we looked at too is, this is something from my old hedge fund days, but basically the 6-month opening range, we calculate that in January, and we also calculate it in July. So you take the first 10 days of the month, you take the high and the low, and you use that kind of like you'd use an initial balance range on an hourly chart or intraday chart. And I'll show you that here in a minute, but we did break to the upside of the July initial balance range, and we found support on it before we got here. So, you wouldn't have a market if there weren't good arguments both ways. Until proven otherwise, I still believe that we're in a process, probably a 16 to 18 month process of working down to the middle of that 100-year channel. Now, I'd point out to you back, and you'll see this in the thesis if you go over the blog, but back in the 70s, we went sideways for 18 years. And we don't know. That might be the same thing here. The inflation's here to stay. So that's why we have to, we have this working thesis, but we stay flexible. So let's see. Let's go to the weekly chart briefly and just, see what we can learn from that. Obviously, I have my, got that volume profile up. So on the weekly chart, I think the things I would emphasize here is, we do now have a follow through on the pivot from last week. So, I mean, once you start taking out these highs to the left here and you close above them, that's a pivot, and that's a turn. And of course, we finally got going this past week, but we've come back up here into this resistance area. And this resistance area goes way back, right? So you've got this, if you really look at it, it goes all the way back here, cuts across this entire thing, really set up the head and shoulders top that we see here. So, and then I drew, this is sort of a working down channel, bear channel, and we're certainly at the top of that. So from just about any standpoint, we're at a very, very important point here. And of course, I pointed out that 4180 major resistance level up here, which takes you up to these highs. So this is a moment of truth. There's no question about it. I mean, it looks real miniature now, but that's that, weekly range there. So I think on the weekly chart, I would focus on the weekly 21, which is the mean up here, and the 5 EMA, and also our Algo trigger line, which is here in yellow. We managed to get through it. We tested it. I mean, all of this looks pretty bullish, and we might even see the 21 kiss the 100-week moving average here and bounce off of it. So, I mean, if you want to make a bullish case, that would be your bull case. Now, my best judgment is we're probably going to come up to these areas, test it. First question I ask every morning is, where are the stops, right? You can imagine all the buy and sell stops sitting up above these highs here. So I think the market will push into those stops and then reverse. That's my best judgment. But what I'll continue to watch on the weekly chart is that the 89, basically the weekly 89 and the weekly 100 period moving averages, we have to stay under those to keep the bear alive. Sure, we can close a week or two slightly above them, but if you look back and study all the bear markets, you don't get above there for very long. And we'll get into some of the other things, but the 50% retracement of the whole rally is sitting up here at 4185. I mean, we can draw some alternative channels maybe. There's different ways we could look at it. There's the channels we were looking at up at the monthly chart. So you can kind of see here's the blue, the middle of the channel where we bounced and different things. But that gives you your basic idea. And then again, even on the weekly chart here, again, you can see those points of support and resistance, and even the ones I drew there. But that's the bottom line for now on the weekly chart. So if the weekly chart closes below the 5-week EMA, I would certainly be, more negative. So like I said, the monthly chart needs to basically stay below the 5 EMA in order for the bear to stay alive. And we can't spend too much time above it. That would be the bull case. And here on the weekly chart, I'm looking more at the 100, the 89 as levels that we have to stay below for the bear to stay alive. And if we break above these levels, then the bull stays alive. I mean, and we sort of have almost an ABC here, but we're kind of, exceeding the 1-to-1 range. I mean, if you were to do a measured move of just this area here, we got a little bit above it. So, if this is going to be a 5-wave rally, I mean, we're just getting started here. So a lot of people say, they're trying to envision, say, well, this might be a head and shoulders reversal pattern. Yeah, it might. And we definitely would see the places that we're going to see those are at important cyclical lows. And this is a 40-week, 9-month cycle low. So this could form that. And that would keep people guessing for a while. So, use your imagination. But to me, I just go bar by bar. And every bar is a trading range as far as I'm concerned. And I just, I'll follow the market and follow the auction. It's not very difficult. And, of course, our algos give us a lot of guidance, too. We'll look at the algo here at the end of the video. So that takes us to the daily chart, which I think is really the most important thing we want to look at here. And let me clear it up a little bit. But I've drawn the shorter term cycles. These are the 20-week cycle. And really the nominal 20-week cycle is the one I follow the most, on a day-to-day basis. And it runs about 15, 16 weeks or so. It's called the 20-week cycle because that's what Hearst called it when he first discovered it in the 70s. But it does vary. And, recently it's been running about 15, 16 weeks. So the next, low comes in at the end of October. And then we sort of have the midweek lows here in the middle of the cycle. So just keep that in mind. I mean, basically, here's your whole 40-week cycle. And you can see it, cycles form M's, if you didn't know that. And then here is the 20-week, is the larger one. And then you've got a 10-week in the middle of those. Or usually we call it the 80-day cycle. So again, the reason, and I kept telling people this, I had a little bit of doubt here, but I've pretty much been on the bandwagon that this was an important low and to treat it accordingly. And like I said, I call it a late bloomer, but it finally got going here. So keep that in mind. The next, minor cycle low is about the 26th of August, and then the next major one, the next 26-week cycle low is at the end of October. The next 18-month cycle low, as you saw there, is not out until early March. And early March would be about the average length of a secular bear market. So that could be where the final low of this whole thing comes in. God knows where that'll be, though, right? So again, bringing down, so here's our windshield, right? This is all we care about this week. Basically anything that's going to land in this range. And for tomorrow, anything that's going to land in this range. And we can look a little outside of it, because it does blow through the range sometimes. But there's that monthly 5 EMA we're right there, and we're actually trading below it overnight. So very, very key resistant level. And of course, all those stops are sitting here, and there's a lot of resistance in here where these lows came in and this high comes in. Now, these are the weekly EMAs, and there's the 89, the 21, and the 100 is right here as well. So, back when I was saying last week, X marks the spot, here's X marking the spot, right? And then these are our daily EMAs. So you've got that, all that resistance is still sitting there. On the daily chart, you want to stay above the 5 EMA for the short-term trend if possible. And note, the 5 is now crossing through the 89, and all these moving averages have crossed through each other to the upside. So again, short-term bullish for sure, although we've come a long ways and probably need to take a rest. And then, we can get into trend lines and things. I mean, there's nothing notable. There'd be a very, very short-term trend line there. Our primary supply line is still up here. And that would be like the ultimate target if, we're going to, keep in the bear market. But I still think that if we take these highs out, you've got to sort of reconsider. And I don't mean for a day or an hour. I mean, they've got to be taken out for a little while. This is the demand line coming up from the COVID lows in March of 2020. So, we're kind of between these two areas. Market can do whatever it wants. There's that very high volume node, which, no coincidence, lines up with these lows and these highs. So my feeling was that since it's within our weekly expected move, we can go all the way up to 4,215. It's hard for me to believe that they won't take it up and run these stops. So I think that will happen, probably earlier in the week. I mean, we come in tomorrow, there's still a lot of people that missed this rally and, are waiting for any kind of a pullback. So it's really hard to get much of a pullback in this, environment. The other thing you always want to pay attention to is where your roundies and half roundies are, 50-point and 100-point increments. Because if you look at the market and study it, that's what the market does. It goes into those 50 and 100-point increments, which is also where all the options line up. And that's where it looks for, support and resistance. So keep that in mind as well. You're basically just pay attention when you're close to those levels, all else being equal. And then these are the Fibonacci projections that I did back in 2009. And believe it or not, in 2009, you can predict where the support and resistance will be now if you know what you're doing. And I would note that at 4,100, one of the most important support or resistance lines we encounter, called a fire line, is sitting there. So that's another thing. If we were able to stay above and maintain above that fire line, it would be bullish, but more than likely we won't. The next most important line is this tree line. And I think what's amazing about this is these lines have been around since 2009, and you can just see how they're working even here, 12 years, 13 years later. It's mind-boggling how that happens. So let me turn those off for a minute. So again, if you're looking inside the sandbox, we got that 4180 high volume node. We've got the support moving average is still sitting down at the bottom of the range this week, and the resistance one sitting up at the top. So keep that in mind. Let's get these off. Now let's look at some Fibonacci projections. So the 50% retracement of this rally, this bear market so far, sits at 4150. I need to get my glasses on here. 4184, 4185. Okay. So here you've got this high volume node at 4180 and a 50% retracement of this first, leading diagonal. And when you go back and study the last 6 or 7 bear markets, the market never got above 50%, a 50% retracement at this point. And believe me, these things are very analogous. In fact, let's go back here because I think it's instructive to look at these. I want to, let's just take a lot of this stuff off, and let's look at the last 2 bear markets and let's lay them over. So here is, let me see if I can get it there. Got too many segments up here. Here is the 2007 to 2009 bear market. And and this thing is tracking almost to the letter. It bottomed at exactly the same place about 29, 30 weeks in. It had about an 8 to 9 week rally, and then it rolled over again. And that's, this was the 1, the 2, and then you get into the third wave down, and it was dastardly. And this bear segment here is gone down faster than any of the other previous secular bear markets, with the exception of the COVID crash. So this has been a pretty aggressive down move. And then if we look at the 2000 to 2003 bear market, it was a little bit different. So, but same basic result, didn't go down quite as far. But it did turn there, and it rallied a little bit and then came down. So, basically this bear market is behaving nearly identical to at least the last 6 or 7 bear markets. That's a better rendition of the 2000 bear, looking at it a little more granularly. So this is behaving exactly like a secular bear market in nearly every respect. And if that's true, then it shouldn't go too much further beyond a 50% retracement at this point. So much above 4,200 for any period of time or any acceptance of price up there would be a pretty bullish sign for the bulls. But for the bears, there's nothing that's happened thus far, no matter how great this is. This is just your typical short covering FOMO, bear market rally, and the bears have a real point in that respect. Now, here is that 6-month opening range I was talking about that we used to do with our hedge fund twice a year. And And basically here was the top at 38.22, the bottom at 37.44. Now, generally speaking, if you break to the upside of the range, that's bullish. So that's another thing in the bullish camp. And you'll see after we broke through it, we came back and retested it. So, that's a little bit of an argument for the bulls. However, we just have to see. It's just a very, very unusual environment. But I definitely wanted you to see that level. And then look at the, June levels as very important. The June mid sits about, at that same level, about 39.14. The June low is 36.39. The June high is 41. I think it's 41.85 or so, or 41.89. So to me, those are your breakout levels. Now, one thing I do is, I always take last month and last week, and I always mark the highs, the lows, and the midpoint. And for the weekly, I even use the weekly pivot because a lot of, traders use that level. And I always have those up and marked on my charts. Now, I don't mark it over here. One of the reasons I like to have and establish a windshield, a sandbox for the week, is I don't like to clutter up my charts because then I can't see the price action. And the price action at the end of the day is more important than anything else. So if I can see those, levels coming into my windshield, I'm going to pay very, very close attention to them. But in general, I want to know where those levels are because I just know that's where the amateurs are going to put their stops. And there's a guy over at Bookmap, his name is Tom, and I get the biggest kick out of him, but he always tells you, think like an amateur, but don't act like one. So right now, it'd be a great ride from here up to running those stops on an intraday chart. It'd be terrific. So keep those things in mind. But what I would say, and I guess a couple of other levels we want to pay attention to here. Let's take a quick peek at the options market because that's pretty important as well. And get it down here on my screen. So first of all, let's look just at, where the options strikes are. Now, we didn't used to care about this stuff, but the options market has become so important. It's kind of like the tail wagging the dog now. And so we got to know where these concentration of strikes are. And you can see here at 4,000, that's actually where the put wall is now. We're sitting here at, 40.50 is a pretty big level. You can hardly see it. 4,100, and then the call wall sitting up here at 4,150 right now. So, these frame, here's where the downside protection comes in here to where the upside is. We're barely over the zero gamma level, but, once you get into positive gamma, your volatility is going to drop a little bit. And, dealers behave more logically. They sell rallies and buy dips instead of when you're in negative gamma, where they sell dips and buy rallies. It's weird. But anyway, here's the gamma flip level. So we get up into this level. We've got positive gamma. We'll see the market lock into gamma spirals to go higher. And here's where we get into the negative gamma, which is where we've been for months. I can't tell you how long it went before we didn't even have any calls up here. You can kind of get a historical perspective. We've been way, way down here in negative gamma, and we're barely crossing above it. So that yellow line is the zero line. And here's the key chart. This is where the gamma is by strike, positive gamma, negative gamma. So you can see that, you've got some gamma here at around 4,100, right? So that's pretty high. And then, you've got quite a bit as you get up here to 4,150, and then it kind of drops off. So all of this is, dealers are going to start hedging into this. So all of this is going to provide resistance, or on the other side, it'll provide support. So keep that in mind. That could be pretty important. Now, let's Let's take a look at the hourly chart real quick, because the final thing I want to cover is, how do we know if this rally is running out of steam? And I think that, looking at the overnight market, we're trading around 41.15 here. We know we've got support at 4,100. We've got support from the moving averages of 50, and we can turn them on down here too. These are the gamma levels from Friday. I won't get the other ones until tonight, so you can kind of see where they're focused. So we've got a lot down here around 40.50, and a little bit of resistance above us. But again, there's the 5 EMA from the monthly chart. There's the monthly 21. There's the weekly. There's the daily. So, somewhere between here and here, we should find support. This is roughly down around the 4,000 level. So, but for the week, we're supposed to stay between 40.50, and we can go all the way up here to 42.15. So again, we're kind of stretched, and I'm expecting a liquidation break sometime soon here. So keep that in mind. But otherwise, that's basically where we're going to play this week. I think that pretty much covers everything. Again, watching kind of the momentum here is falling off on the RSI. It's falling off a little bit on this is a modified MACD support and resistance level. So, it like I said, it's going to try to pull back a little bit, but I still think the FOMO crowd's going to be all over any dip of any magnitude. And I've yet to see the sellers come in, and the trading desks at the big firms aren't seeing it yet either, so keep that in mind. Let's take a quick peek at the Algo. Whoops, that's not what I wanted. As soon as I find it. That's a problem with having too many computer screens, right? So let's take a quick peek at the Algo here. This is a daily chart. Make sure I've got the overnight data on, and we do. So what's the algo telling us? Well, one thing, it's telling us that the uptrend is stalling, that we're getting into a kill zone. Trend state's still bullish, but the strength is weak. That should be over 25. And it's telling us that on a gamma calculation that a trend reversal is imminent. So I'm going to pay attention to that on a daily chart. These are just telling us where the sell stops and buy stops should be. And this is giving me an idea of the range of the bars. But this E stands for exhaustion. So we came out of a volatility squeeze, which is marked by these dots. We had a couple of different buy signals. We had multiple buy signals. And we basically worked this rally, and then this rally. And we got a little bit of this rally on Friday as well. So, it's one of the best Julys we've ever had. Our firm strategy's up over 200% for the year. Now, no guarantees that you'll get that or anybody else will get it, because the past doesn't always indicate the future. But, since we started our strategy 3 years ago, it's been up triple digits every single year. So we worked with these with some SPY calls. It worked out really, really well. But it's overdone. So we got to be careful here. We're almost at a 3 ATR level. So again, I still think the best idea here is we're going to probably duplicate something like this over here on the right, stall a little bit, maybe have a liquidation break sometime later in the week, and then we'll see where we go from there. So, if you know where your sandbox is, you know what you're going to encounter there, and you figure out where the stops are, you've got a pretty good game plan. And the idea, whether you're going to go long or short, is to get positioned, because what the market's going to do is it's going to go from level to level. It's going to test the overnight high. It'll test these highs, and it'll keep going. If it can, it'll go to the next important level. I always look at the initial balance for the day, mark those. I mark all the high volume nodes, and I just travel level to level, and I try to get positioned. If I'm going long, I try to get positioned under the POC for the day, and I'll usually take one position up to the POC. Actually, I like to do 3 futures contracts. I like to do one to break even and move my stops up, and then I take one to the POC and then one to the runner. I'll take a runner up to whatever the next level is. It just depends. And I'm constantly monitoring the auction, because that's going to tell me when things are going to, peak out. So you can see here, like tonight, this is just looking at tonight, right? And, there's a high volume node sitting right up here that's keyed off the monthly and daily charts, right? Now, look at the auction here. This is where the fair value is right now. This is too high. You're only getting 11 contracts going on up there. This is too low, only 35 contracts. And this is just looking at what's on my screen. But for the night, you can see a nice symmetrical profile here, right? So fair value tonight has been 41.18 or so. And that's where the POC is right now, the point of control. And then when we got up to 41, basically 41.21, it was too high, right? So you only saw, well, actually went a little higher, went up to there's the 5-month EMA sitting right up there, right? And I must have gone off earlier tonight. Let me just scrunch it up here. And we can see what happened tonight. So let's just look. So we gapped open just a teeny bit. And, we did see some things go off up here at yesterday's high. And then we came right back down. You can see all the stops running up there. Just take another peek here. Sorry if this is hard to read. But yeah, they basically took it up. These are adding positions here. These are all the institutional orders. And you can see we opened up here. Actually, a little bit above settlement from Friday. And the sellers came in immediately. And we brought it down. And so now, like if I were trading this tonight, like, okay, I know there's stops sitting up here. I know there's stops sitting below these lows. So, and this is, pretty symmetrical down here where we've stalled. I mean, we didn't do any volume up here at all. So obviously these prices are too high tonight. And that's what an auction's all about. So basically, you can take trades from here up to the point of control. If you can get position, how many points is that? It's only about, 5 or 6 points. That's not a lot. I mean, you could trade multiple contracts and do it. Notably, the point of control is moving down tonight, so that's probably a slightly negative. But you can, when you get granular like this, you can tell a lot. So for right now, there's the fair value right in the middle. You don't want to position there. There's too high and there's too low. So you get position down here and ride it to the POC. Because this is fairly well balanced right now, you could probably trade long and short. It's just not a big distance for me that I'd be interested. But when you see this develop during the day and you've got, 10, 15, 20 point spreads, it's pretty attractive. So bottom line is, at least from a big picture perspective, we're coming off the 40 week cycle low. We're progressing nicely, but we've got to the point where if this is going to continue to be a bear market, we can't go too much higher, maybe a little above 4,200 before the market would have to stall and maybe head lower. If this is like the last 6 or 7 bear markets, going back to the 70s, the market could still go higher. It could potentially form a trading range. There's other possibilities, but that's just kind of the most likely scenario on the table. And from a daily perspective, the market's overbought and it's stretched and probably needs to pull back regardless. Whether it's a bull or bear, it still needs to pull back. And the different narratives, they both have good arguments. I'm sort of on the side that we're still in a bear market until proven otherwise. And, at some point, I would want to sell this rally. And the auction will tell me when that point is, right? When you look at a profile and it's getting thinner and thinner because there's less and less interest at that level, then that price is being rejected. And if you weigh that with everything else you're looking at, then that gives you a pretty good sense of whether a reversal is imminent. And of course, I wrote some algorithms and things to tell me that, so I don't have to keep track of too much. Don't have a sell signal yet, just so you know, but it is warning us that the price is exhausting. And typically that will lead a top by a couple of bars. So it might be till Tuesday or Wednesday. We'll see. Remember too that the bar from Friday isn't super big, right? So, it wouldn't take much for us to take out the low of that bar, and that would certainly be negative. When I'm day trading, what I do is I look at the algo on a 15-minute chart, and I take my guidance from there. And I always use the day session data. I don't use overnight data in my trading strategy. Not that that's right or wrong. You can do whatever you want, but for me, I just don't do that. And on the 15-minute chart Friday, we had an SOB signal, and that does not stand for what you think it does. That stands for super overbought. And I think we're even potentially getting some exhaustion signals. If we look back over to the hourly chart and we throw up some DeMark indicators, we're definitely getting, we're hitting some 9 and 13 counts over here, especially if you just keep it on the RGH, regular trading session data. So you had a 13 count here, a 9 count here. So I think we're getting ready to pull back a little bit here. But like I said, FOMO's a powerful thing. And if you're a money manager and you get caught, in cash when the market's rallying, your clients are going to be mad, and that. So, a lot of people may be forced to chase this. So I don't know. There's a lot of cash on the sidelines right now, and it can definitely fuel a rally. So it just really comes down to, how strong these money managers are in holding to their ground and holding to their opinions. You can be really, really punished for being wrong. So anyway, let me leave it there for the night. I went even longer than I thought I would. Hope you enjoyed this. If you did, please consider giving us a thumbs up. Please share this with other people. Help us build our community and channel, and consider joining the community. We do have a lot of fun, and we enjoy trading and making money, as I'm sure most people do. And you'll learn a lot. Head over to the website at blueprinttrading.com. No E in Blueprint. And go to the blog. There's a lot of free information over there that's hopefully helpful. And other than that, have a great trading week ahead. I'm sure it'll be interesting. We still need to see if old Nancy's going to land in Taiwan and how that's all going to work out. And, just whether we can go into World War III, and whether what other great decisions that the Orwell administration has in store for us. So I'll sign off with that. Have a great night. Bye-bye.